Hello and welcome to the Currency Exchange, NatWest Markets FX podcast, where we break down the major themes and events driving currency markets this week and the weeks ahead. Today I'm joined by Paul Robson, who is our head of G10 FX strategy here in Europe. Paul, I have to start with sterling's incredible resilience through all this Middle East turbulence and the conflict playing out there. What do you think are kind of the main factors driving the support for the currency?
Yeah, it definitely seems a surprise. It's the number one question that I get asked. It's right up there with where is the dollar heading? So it shows that it's on people's mind. FX in generally for the major currencies have been relatively quiet through the conflict. I think I called them the bad boys of financial markets in one webinar that I did. The FX tends to be a little bit more volatile to say equities, credit, and bonds. It always seems to be the first one to react, and that's right, because it's an easy way of sort of hedging other assets that people might hold, and you can do it relatively quickly while you decide what to do with your other positions. But certainly sterling's resilience to the Middle East conflict is definitely up there with some of the bigger surprises, and also at a time when the gilt market has also been relatively volatile, and politics have come into focus. So you take those three together, and it is certainly a surprise that the currency is held up so well. In terms of the Middle East, the energy price shock does tend to play more towards the UK's fragility. So whether it's net trade, relative growth, relative fiscal policy, or political risks, you have a quartet of risks there. And they just don't seem to have been landing the punches that they normally do. So with FX, if you exclude all the things that you think should or you would expect to drive a currency, whatever's sort of left must be the reason. And it seems, from my point of view, that it must be some kind of safe haven flow from the Middle East that's supporting the currency, that's leading against some of those other negatives. And of course, the UK has had traditionally strong links with that area of the world over many, many decades. And it may well be that, having seen an outflow of capital over the last sort of 18 months, 2 years, but maybe to that region, that might be flowing back home. There might be some move out of the GCC currencies that would have normally been held in dollars. Maybe some of that is being sent to the UK. Other areas to think about, certainly the fact that gilts are underperforming, but they're not underperforming in a particularly volatile way. If you get a pickup in gilt market volatility, that might be a sign that maybe sterling resilience is set to crack. And it also might mean that those economic agents in the market, so those investors that have a sort of a leverage position, or are more quick to invest and take profit, so what we would call fast money, maybe they just don't have the firepower to position for sterling weakness after what has been quite a challenging 2026 for certain investors.
So really multiple factors really kind of underpinning sterling at the moment and kind of explaining its resilience. But, I have to ask you, we're kind of on the eve of, local elections here in the UK. Do you see risk for sterling going into this episode? Are those kind of credit risk first and foremost still in investors' minds?
Yeah, as you said, we're recording this podcast as people go to the polls in the UK. These are regional and local elections, obviously not a general election, and we'll get the results after we released this episode of Currency Exchange. In the past, certainly politics has seemed to move the needle on sentiment towards sterling, because it comes with increased uncertainty, maybe people are a little bit more unsure about fiscal policy going forward. I'm not really bothered about my own views about politics and fiscal policy and spending and taxes, for example. All I'm interested in is how financial markets see it. And in the past, people have worried that it does lead to weaker growth, higher spending, potentially higher borrowing. I think for this election, the polls look pretty clear. But what I would say is, I think politicians will be wary of acting in haste and having to repent at leisure. And so I don't think this week's elections will have an immediate impact on the currency or UK assets. As we go through the year, I think maybe the implications of the results might have a greater bearing on the UK political outlook, particularly into the autumn where you get the party conference season. We'll have a budget in November, and then obviously we have 2 years to run down into the next general election in 2029. So I think it's a case of perhaps increased volatility in sterling in the second half of the year is the main implication of this week's election. But when we think about the volatility, there is two things in the UK that appear very strong. And the first one is the gilt market's ability to draw very deep red lines on what it thinks is appropriate in terms of fiscal policy. And that tends to rein in some of the more extreme calls for changes in fiscal policy. And I think that that's important. And the second one is the independence of the central bank. I read occasionally about the Bank of England eventually trying to accommodate a looser fiscal policy position in the UK, but they are independent. They have a mandate of setting policy to meet an inflation target, not to allow for fiscal policy to be loosened significantly. And I think once you bring those both together, yes, politics might prove to cause volatility in the currency, but I don't think it has an enduring negative impact on sterling as we look through the rest of the year.
I guess, the big kind of risk coming up in the next week is that summit between China's Xi and of US President Trump. I guess from my perspective, there are kind of three main topics that are going to be on the table for this discussion. So I think Iran, Taiwan, and trade. Coming to Iran first, I think part of the US's recent push to end this conflict with Iran is likely motivated by this upcoming summit. If the war is still going on into this summit on the 14th and 15th, Trump really goes into it on the back foot. China is kind of seen as being a potential key broker of any kind of peace agreement between the US and Iran, because it is one of the very few countries that actually maintains traditional diplomatic relations with Iran. It's actually was a country who's credited both from the US and Iran with actually putting pressure on Iran to accept that ceasefire agreement. Coming to the issue of Taiwan, this is kind of a main reason why Trump doesn't want to go into the summit on the back foot, is because he doesn't want to have Taiwan on the menu in any kind of quid pro quo. China's foreign minister actually previously said that, Taiwan is the biggest risk when it comes to China-US relations. And Trump has already been in trouble with Xi for supplying weapons to Taiwan. So any kind of pressure that's put on Trump to effectively, change, I guess, the US's recognition or the US's stance around Taiwan, and for instance, recognizing China's sovereignty over the island would be a big foreign policy win for China and would have big implications for the Taiwanese dollar and the country itself. The third factor is trade. And I guess this summit was supposed to originally be all about trade. I think the key thing here to recognize is even though we had that agreement back in October 2025 between the US and China over rare earth inflow into the US still is not back to kind of pre-trade tariff tension levels. The US will obviously want to secure increased access to these critical minerals because they obviously are so important for new technologies and for the AI race. But Paul, kind of coming to you now, what do you think are kind of the main risk factors for G10 currencies off the back of the summit? And how do you think the market is generally positioned going into this big, long awaited event risk?
Yeah, in terms of the major currencies, I think a lot of this will just come down to the reaction of risk markets, the dollar's correlation with equity markets and general risk sentiment has remained relatively stable. I know that there's lots of talk about the dollar gradually losing its safe haven currency status, but there's really very little evidence that that's the case. So I think that markets will see this coming together of Xi and Trump very much through equity markets and the impact on the dollar. And I think it's a really interesting story here about what will drive the dollar into the future and the rest of the year, given that medium term outlook for perhaps the dollar or de-dollarization or de-Americanization, however you want to talk about it, whether that is a story that can endure and build, or whether it will fade into the background and we'll be back to just looking at cyclical factors for the dollar. And certainly from my perspective, when I think about the outlook, it de-dollarization and that topic has three main areas, and it's that use of the dollar, the reliance on the dollar, and exposure to the dollar or US assets. And the way you describe the summit and the talks, that's very much centered on the use and reliance, the sort of safe haven aspects for the dollar. But I think as we go forward through the rest of the year, it's going to be more about investors' willingness to have exposure to the US in the same level or degree as they've had in the past. And on this podcast, we've talked about a lot about shifts in FX reserves, which is separate from the dollar as a global reserve currency, asset allocation, and hedging of FX exposure to the US. And I call it a $70 trillion question. That's how many assets the world owns of US assets. So it's obviously a big number, and small changes have a big impact. And then also the funding requirements of the US current account deficit is 1 trillion a year. So the dollar needs to attract, or the US economy needs to attract $1 trillion of fresh capital every year if it's not to fall. And I think that when we think about some of the drama and noise around the US policy outlook, I think ultimately over months to come, quarters to come, the balance of risk is to a weaker dollar rather than a stronger dollar.
I think that point around, if the US is seen as sacrificing its traditional allies in this meeting, it will have knock on implications. And as you say, kind of builds into that de-dollarization theme. I guess kind of from EM markets point of view, I think looking perhaps more shorter term, we're kind of taking a more cynical approach. So it's been interesting that China has systematically actually allowed the CNY fix to appreciate over the last year coming into this meeting, obviously cognizant of kind of US previous accusations that it was competitively devaluing its currencies. This morning it set that CNY fix strongest level since March 2023, and as we record, it is approaching the 6.8 level, so really trading very strong relative to historical levels. We do see that as kind of a preemptive kind of posturing move going into this summit. And to be a bit cynical, I think there is a risk that, Chinese authorities really push back against that CNY strength in the aftermath. But that is probably all we have time for today. Paul, thank you so much for joining me as always. If you did like the podcast, please do click like and remember to subscribe so you get the latest episode first. Thanks again.